Okay, so picture this. It's 2021. Carvana's stock is trading at $370 a share. The company is worth more than Ford. Ford, a 120-year-old company that makes actual cars. And Carvana? Carvana is a used car dealer that made, at that point, no real profit. Not once. How does that happen? Well, here's the thing. It doesn't just happen by accident. There's a story here. And it's not just a story about a company that got too hyped up and crashed. It's about real people who lost real money. Employees who got their life savings wiped out. Regular investors who trusted the pitch. So today, we're going to break down 3 things. First, how Carvana built this illusion of profitability, like the actual accounting moves they used to make garbage numbers look good. Second, the loan scandal, because this is where it gets genuinely wild. There's a company called DriveTime. There are related party transactions, and then there's a guy named Ernie Garcia II who you really need to know about. And third, what the collapse actually cost people. Not in abstract billions, in real human terms. Stick around for the end, because I want to ask you something specific. Alright, so let's start with the numbers. Carvana went public in 2017, and from day one, the pitch was, we are the future of car buying. Vending machine towers, no dealerships, pure tech. The stock market ate it up. But here's what's actually happening under the hood. Every time Carvana sold a car, they were often losing money on the actual transaction, like the car itself. They'd buy it, they'd recondition it, they'd market it, and sometimes they'd sell it for less than it cost them. That's not a business, that is a donation. So, how did they keep showing growth? How did they convince Wall Street things were going in the right direction? 2 words: loan origination. When Carvana financed a car for a customer, and they pushed financing hard, by the way, they'd immediately sell that loan to a third party, and they'd book the profit from that sale right now. Not over the life of the loan, right now. Actually, let me rephrase that, because the timing is the whole point. They weren't earning money from interest payments over 5 years, like a normal lender. They were selling the future value of those payments immediately and counting it as current revenue. It's financial time travel. You're borrowing profits from the future and calling them real today. And investors didn't always clock this, because the top line numbers kept going up. Revenue, growth, the vending machines. Look at the vending machines. But underneath, the actual unit economics were a mess. They were spending something like $4,000 to $5,000 more per car in operating costs than they were making it back. And they were doing this at a massive scale. So the losses weren't small. They were scaling with the company. Here's the thing about building a story around growth. Eventually, you need the underlying business to actually work. You can't just originate loans forever and sell them and call that a car company. At some point, someone asks, so wait, do you make money selling cars? And the answer for a very long time was, not really, no. Okay, this is where it gets personal. Ernie Garcia III is the CEO of Carvana. His dad, Ernie Garcia II, is the founder and majority owner of DriveTime, which is a separate used car company that sells to subprime borrowers, people with bad credit, high-risk loans. And here's where it gets, well, it's a little bit complicated, but stay with me. Carvana wasn't just selling loans to random investors on Wall Street. For a significant period, they were selling a huge chunk of their loans to DriveTime, affiliated entities, to essentially a company controlled by the CEO's father. That's a related party transaction. And related party transactions aren't automatically illegal, but they raise a question. Are these loans being sold at arm's length? Are you getting fair market value? Or is dad doing his son a favor? Is son doing dad a favor? Where does the family business end and the public company begin? Hindenburg Research, a short-selling firm that makes money when stocks drop, so take that with appropriate salt. They published a massive report in 2022 laying all of this out. They alleged that Carvana used these transactions to paper over losses, to make the financials look cleaner than they were. And the SEC opened an investigation. Now, nothing has been definitively proven in court as of when we're talking. I want to be clear about that. But here's the human side of this that I think gets lost in the regulatory language. Carvana had tens of thousands of employees, regular people. A lot of them had stock compensation, RSUs, options. When the stock was at $370, some of them were, on paper, genuinely wealthy, buying houses, planning for retirement, thinking their bet on this company paid off. And then, well, by late 2022, the stock hit $3.72, a 99% collapse. That's not a rounding error. That's someone's retirement. That's someone's down payment on a house. Gone. Meanwhile, the Garcia family had been selling shares near the top. Senior executives, too. Perfectly legal. They filed the right paperwork. But when you're a regular employee watching the people who told you to believe in the mission quietly unloading shares while you're still holding, there's a particular kind of betrayal. Right, so let's talk about what happened when the music stopped. In May 2022, Carvana laid off 2,500 people, about 12% of their workforce. The layoffs came via a Zoom call that people on the call described as, cold is not a strong enough word. People found out they were losing their jobs in a mass video call with no real warning. Think about who those people are. It's not the executives. It's customer service reps, logistics coordinators, people in the car vending machine facilities, people who move cities for this job, people who turned down other offers because they believed the vision. And then there were the retail investors. Here's something I find genuinely troubling. During the peak hike, Carvana was a Reddit stock. It had a passionate retail following. Regular people, not hedge funds, not institutional investors who risk with risk teams, but 24-year-olds with Robinhood accounts were loading up on CVNA because the story was so compelling. The disruption narrative, the sleek app, the no haggling pitch. People genuinely connected with the product, and then they bought the stock. Those two things should be separate decisions, but they weren't. And the losses those people took were real. We're talking billions of dollars in aggregate that came out of ordinary household accounts. Now look, Carvana did survive. They restructured their debt in 2023. The stock actually recovered significantly, and they started posting what looked like real profits. So this isn't a death story. They're still operating. But that recovery doesn't give back what people lost at the peak. The employees who got laid off didn't get rehired. The retail investors who panic sold at $4 didn't benefit from the recovery. Survivorship doesn't undo the damage. And the fundamental question, were investors given an accurate picture of this business during its growth years? That question hasn't been fully answered. So here's where I land on this. I don't think Carvana is straightforwardly evil. The underlying product, buying a car online, no pressure, no dealership games, that's a real thing people want. The demand is real. But there's a version of this story where the financials were structured in ways designed to obscure how far the company was from actually working. Where growth was the product being sold to investors, not cars. where insiders understood the gap between the story and the reality in ways that ordinary investors didn't. And that gap? Well, that's where people got hurt. The thing is, this isn't unique to Carvana. This is a pattern we see over and over in the era of zero interest rate money flooding into growth tech. You build a narrative. You get institutional backing. You go public before the model is proven. You sell the future, and by the time the future arrives, the people who built the narrative have already gotten paid. It's not always illegal, but it's worth asking whether it should be more regulated, whether the rules around how companies present their economics to retail investors are actually protective enough. Here's my question for you in the comments. Do you think the problem with Carvana was a few bad actors making specific choices? Or is this just what the incentive structure of modern public markets produces automatically, no matter who's in charge? Because that answer matters. It matters a lot. If it's bad actors, we just need better enforcement. But if it's the system, then we have a much bigger conversation to have. Drop your take below. I read all of them. And if you want to go deeper on how public companies use accounting to manage perception, not just commit fraud, but manage perception, there's a lot more to get into. Hit the subscribe, and we'll keep pulling threads.